In 2026, with more federal attention on banking practices than at any point in recent memory, you would expect banks to be closing fewer business accounts. They are closing more. The reason comes down to how banks respond to regulatory pressure, and the response is almost never what businesses expect. When regulators increase scrutiny of banking practices, banks do not become more permissive. They become more careful. And careful, in banking, means reducing uncertainty wherever it exists. The de-risking process, the practice of exiting relationships the bank believes carry more compliance costs than value, has intensified in 2026 because the regulatory environment has made the cost of holding uncertain accounts higher than it has ever been. A business account that might have been retained under closer monitoring 2 years ago is now more likely to receive a closure notice. Not because the business did anything different, because the bank's calculation about what level of uncertainty it is willing to carry has shifted. The accounts most at risk right now are not the ones with obvious problems. They are the ones that have accumulated enough open questions over time, documentation gaps that were never fully resolved, pattern shifts that introduced uncertainty without context to explain them, review history that left the bank's file less clean than it was when the relationship began. Each of those things raises the probability that in a 2026 de-risking review, the bank decides the relationship is no longer one it wants to carry. The businesses that will move through this environment without disruption are the ones whose account files give the bank nothing to act on. Not because they are larger or more profitable, because they are cleaner.